So we're recording the lecture, okay? Chapter 13, I'm starting with the homework and classwork. And I already mentioned to you that the homework doesn't make much sense, but that's what it is, all right? All right, where are we? Okay, I don't have it ready yet. Let me just double check. Oh, there you go, I found it, okay. By the way, I had issues with this internet connection that I'm using at the moment yesterday during my class. So I'm preparing you that it's possible that I crash, but in less than 30 seconds, I'll be back. So don't go anywhere, okay? That 15-minute rule, waiting the professor still could apply. I'm not gonna take 15 minutes to come back, okay? If I don't come back in 5 minutes, then could be an issue, big one. But it shouldn't be more than 30 seconds, so be prepared. That could happen, okay? That I will crash. All right, so if you don't see the dashboard here, and I'm gonna click on your class, there you go. If you don't see the Canvas page of your class, let me know, okay? That's what I wanna share with you. It's slightly different than yours, but everything we need is here, okay? And it's in yours as well. All right, there you go. So here, classwork, chapter 13, and homework, same chapter. I'm gonna make the homework solution available for everybody. There you go. So that's how it's gonna be from now on. I will make it available. There you go. It's gonna be a file like that with the name of the chapter, with the problems for every assignment at the end of the chapter. So every problem, every exercise, every practical exercise, etc., the answers will be in that file. You just need to focus on the ones assigned for the weekly assignments. That's all the ones you need to focus on the solution, but you have more there. Okay, so I'm gonna use that file, okay? So if you click and open, should take you to something that looks like this. All right. All right. And I'm gonna go in order here. So the first one in my list, if I recall correctly, is the exercise 1. There you go, it is. So I'm gonna go over those exercises, especially the problem 13.1, okay, and the one from the homework. I'm going to spend some time on those two problems. Make sure you follow, okay? Because the candidates for the exam, the questions that are candidates will be more like this one, which you have to demonstrate that you know how to compute the effective interest rate. So I'm going to spend some time on those two problems assigned. And those ones here are kind of in between, okay? And include both. Remember that I said chapter 13, I divided in two parts. One part is the investments, okay? In small investment, we call the passive investments, the semi-active and the active investments, right? And then the other part is the interest rates and the effective and the straight line method of amortization. This is the chapter 13. All right. So problem 1 or exercise 1 is precisely regarding investments. So take a look. The answer is, I don't have the questions. Where am I? There you go. I don't have the questions here. So double check if you have those answers here, okay? And in the meantime, I'm explaining the difference between those answers here. So remember, we have 3 types of investments. Let me go by parts. You have 2 types of investments. One could be passive, and the other one could be semi-active. The third one that we call the total control or active investment, we don't see on this chapter much. So didn't even ask any questions regarding that. So we're gonna focus on those 2 types of investments, the passive and semi-active. If it's passive, there are 3 categories, okay? which in the United States is available for sale, available for trading, and held to maturity. 3 names, okay? This is not a memorization class, meaning the exams, you don't need to memorize anything. You're going to have access to the information. But for a CPA exam, you need to memorize this, okay? You need to memorize this difference and the classifications of each investment. All right. So if you have the intent to sell, if you need money, if you need cash later on, then it's the category is available for sale. If you have the intent to make money with that investment, so like profit on the investment itself, then it's called available for trading. And if you have semi-control, you have some influence in another business, so it's not a passive investment, you use the equity method of investment. And if you buy a bond, okay, and you intend to hold that bond until matures, then it's a HTM classification, held to maturity. All right, I want you to feel confident. There will be one problem on your first exam precisely on this topic, and you're going to have to do like a matching. You're going to have to read and decide which one of those that investment will be, okay? So make sure you understand the difference, especially between available for sale and available for trading, okay? All right. On advanced accounting, for those going to that class, you're going to understand the impact on your profit that each classification will have, but not on this class. Okay. Don't recall if I asked you to do two. I think I did. I should have put an item there, just item 1 only, which is more important. But I want to answer 2 and 3 since it's here. All right. So remember the 3 classifications on the United States, okay, is regarding the intent of holding until maturity, or you have the intent to make profit, or you have the intent to use if you need money. Financial distress, as we call it. Outside the United States, we don't have those 3 classifications, the available for sale, available for trading, and held to maturity. We have 2 classifications for the passive investments: fair value or amortized cost. That's it. And we have this, they have outside the United States the same method of accounting for semi-active investments, not the passive ones, right? Okay. The most important thing on this problem is knowing which one is what, okay, or which one is which here. Okay, questions on this one, because I'm moving to the next one. All right. Good. I mean, just a little comment. If you don't have any questions, and assuming that you understood this pretty well, this is very good, okay? This is not an easy material to memorize or to understand. There's a lot of these 2 different classifications. So again, so my comment that if you learn this well, you're in a very good shape. All right, 13, 2, 7, and 8. Let's see if I have to do all of them. I probably will. All right, second one is journal entries. No, I'm not big in journal entries, okay? Because in those days, we have softwares that do that for you. So I assigned this. You're probably not going to see a journal in the exam, but you will see, you will eventually see this in, especially if you're working as an accountant, right? And I want to emphasize in every class I teach the importance of the financial statements and the documents that you need to have to account for your numbers in your business or the business that you're working for. So the journal is an important one. So it's always good to remind you how it's done. Although I wouldn't be too concerned, okay, in terms of importance for this class, how important it is to know how to do the journal, okay? And one parenthesis or comment here, the journal, the accounts that you're gonna see here could be called different again, I warned you that this would happen, okay? So that was quick. Let me go back. I don't think I'm sharing the screen. All right. I think as long as we're prepared that this could happen, then would minimize people getting a little frightened when this screen just disappears, I guess. I'm back. All right. And this was posted for you, by the way. So if you don't want to follow here, you can just open the file yourself on your laptop and check there. It's up to you. Okay. All right. So again, what I was trying to tell you is I don't want you to feel too nervous about memorizing names of accounts. What I want you to remember is the basic structure of a journal, which that's what I'm going to address going over this problem. Okay. Some of the computations regarding interest, okay, and you're going to see this in more examples when we do the table, the interest rate, effective interest rate table that's coming on the problems, okay? So here I just want you to really remember the components of the journal in the concept of debit and credit, okay? Because chances are some of you have forgotten at this point, okay? I hope not, but again, right? This is an accounting class, but I don't know, okay? I don't know. So look at this. Every time that you invest in something, you're purchasing an investment, right? You have to remember this back from financial accounting. When you purchase an asset that has value, you're gonna debit, right? Imagine that you purchase a vehicle here, right? Then you put vehicle, debit, and how do you pay for that vehicle? Using cash, you credit cash. So I want you to remember that the first account in the journal is the debit account. That's the debit column. So this column here is where the numbers of the debits will be on this first column. And then you have the second line here, the credit account. You see that the number is the same, but is on the other column, okay? Creates kind of like a hexagonal way of looking, right? Diagonal, I guess, excuse me, right? So it's on purpose. It's easy to see that way, right? Than if it was one on top of the other. It's just a visual presentation, okay? Notice that you have to create a diagonal filling here as well. So the account being debit, you have to indent down here for the credit, okay? Those are the structure. Like I said, I'm not going to test you on this because the softwares are doing all those journals on those days, right? But it's good to remember, right? So what you purchase, you debit, and how you paid, you credit. That's it, okay? If you don't want to call this investment in HTM debt securities and you want to call something that makes sense, fine, right? As long as you debit, otherwise it's going to have an impact on your financial statements, and that's not good, right? But as long as you do it on the right place, I don't really care how you call it. Well, it has to make sense, obviously, right? You cannot put here inventory, right? Or you cannot put here salaries payable, right? Because it doesn't make any sense. So as long as you call something investment in bonds, that's fine, right? That's okay. If you want to be more specific, that's fine too. All right. Next, this is basic structure of bonds, okay, that I'm using this example to explain it to you. You need to know what's the basic structure of a bond. What is that investment, okay? Means that you give money today, a chunk, big chunk, and you're gonna get installments, periodic installments that we call interest payments. And at the end of your contract, you're gonna get the money back, the one that you gave it, the chunk you gave in the beginning, you get it back at the end. Okay, that's the basic structure of a bond. But of course, it has variation in terms of values, etc. We're going to discuss that when we arrive at the tables. But right now, just remember that, okay, day one, you purchase the investment. There you go. You debit. Credit how you paid. You paid $483,000, almost $484,000 for that investment. Day one. All right, perfect. Then you wait 6 months and you're going to receive some money. How much? You're going to receive, and it's stated in the problem, obviously, right? You cannot guess those numbers. Face value of the investment, you pay 483, but the face value was 500. This is what we call a discount bond. Okay, if you purchase for less, then we'll pay in the end. Okay? Or, okay, discount bond for the investor, right? Bought it at less. Okay, the bond pays 9% interest every 6 months or half a year, right? So every half year, you receive 500,000 times 9% divided by 2, okay? 2 payments. 2 payments or 22,500 bucks. So that's step 1. You need to remember how to compute interest payments of a bond. Very easy. Face value times the interest of the bond times divided by 2 if it's 6 months, or just as it is if it's per year. All right. Now, what is important here, and you have to remember, is that if you paid less than you're going to receive, right? Remember, you're going to receive 500,000, right? Or the value is 500,000, the face value. You paid less, okay? Then that difference, okay, between face value and the amount you paid, okay, has to be amortized during the life of the bond, okay? That amortization has 2 ways to be done. Or you can do it in 2 ways. One is the straight line method, which is the one used here that I'm highlighting. Or you can use the effective interest rate method, which requires a table, okay? The straight line method is very easy, and I'm going to show it to you if you haven't got it, if you haven't understood that yet. Very simple. The effective is more complicated and requires the table. So look how easy it is. Take how much is the face value minus how much you paid, divided by the number of payments. Okay, if bond's 4 years, pays twice a year, you have 8 payments. Right, divided by 8. And every single payment, okay, you're going to have to amortize that amount, 2,019.78 in this case, okay? So that's what the amortization is, right? So you debit your cash for the interest that you receive. You're the investor, you're receiving the money. You debit the investment on bonds, the one that you purchased for 483, you debit for the difference. What's going to happen? It's going to increase that value. It's going to go 485 and change. And then it's going to increase again. It's going to increase again by every time by 2019. After 8 payments, that 483 will become 500,000 because you keep adding the amortization. That's the idea on the accounting point of view. Okay? All right. And the name of the revenue, it's called interest income or interest revenue because you're receiving that money and you're going to pay taxes on this money. Okay, you're going to pay taxes on 24,000. You're not going to pay tax on 22,000. Huh? It's brutal, huh? But that's how the IRS is. You're going to pay on the full amount. For those trying to understand why is, I'll tell you why. You got an investment that's worth 500, you paid 483. The IRS think you had a gain here at the beginning. So you're going to be taxed on their amortization. Okay, more or less, not exactly that. You know, the rationale is more or less what I just said. Okay. Now, Henrique, in every month, every 6 months, look at this. I copy and paste here, friends. You copy the cash. You copy the investment and you copy the interest income exactly in the same position. 2 debits, 1 credit, exactly in the same amount. Is that anyone that want to ask a question? I saw someone throw. If you had paid 510,000 for something that will be face value of 500, there's a 10,000 difference that you paid more, right? Then that difference will be amortized in the credit side, not on the debit side? Very good question. All right, and you keep on doing the same copy and paste, right? Cash debit, investment debit, interest income credit, every 6 months, okay? Until the end of the maturity of that bond, okay? Now, continuing the same problem. The only thing that will change from part one to part two on this problem, okay, is the method that you're using to compute the amortization. I found very easy to use the straight line method, right? You do once, get that amount, and that's the same amount every 6 months. In this case, it was 2019-78. Every payment, you amortize that amount. That's easy. When you go to the other method called the effective interest rate method, which is the preferable method, right? Because more accurate, reflects reality better, then you're going to have to although the debits and credits do not change, the amount that you're going to amortize will change payment after payment, right? That's why you need a table. You need a table in Excel that I'm going to show to you soon. And from that table, know exactly the amounts to amortize. So you're going to copy from that table and put it in a journal, right? That's what you're going to be doing in real life. Goes from that table to the journal, okay? Here, you're going to have to do the calculation because you have to demonstrate that you understand. I found it annoying to do this way, but it is what it is, right? So, and you're going to see from the Excel, the computation is that you compute the amount of interest that the bond would pay you normally, and then in this case would be 22,500 every 6 months. Then you take the value that you paid for, in this case was 483,841, and multiply by the current interest rate, which will be different than the bond, okay? That will give you the amount of 24,192 semester, right? Twice a year, okay? You have to divide it by 2. That difference is your amortization. That's what you put in the journal. So note that the debit and the credit is exactly the same as the straight line method. It doesn't change. What changes is the amount, okay? One goes $2,019.78 amortization every payment, and the other one will keep increasing, okay? It was 1692, then it's gonna be 17, it's gonna go 18, 19, etc. And in the end, both amortization will equal to the same amount, okay? One just goes same amount every payment, and the other one varies. That's it. So this problem here is for the journal. It's more important for me here that you got the journal correctly, even though, when I say correctly means it doesn't have to be identical. Cash has to be identical. If you put interest revenue, interest received, okay, that makes sense. Interest revenue, interest income preferable. And here, if you put investment on bonds, investment on debt securities, or as is written here, not a problem. Okay, so that's it for the feedback on this portion, the first part of the chapter 13, which will be the investments on security, the classification and the journal. Reminding you that there's no journal of this on your exam, okay? Eventually you have some journal entries that you have to do, and I found important, but this one here is not that it's not important, is that the software will do it for you, okay? So it's more important for me that you just understand the concepts. All right, so I'm gonna move on. Let me see if it's 7 or 8, because they are, if I recall correctly here, interest rate tables, not the effective and the straight line. Definitely the 13.1 is, let me see what I have for homework. 4 and 17. Let me take a look on 4. If it deserves a little comment. Okay, So allow me for doing 4 as an example when I start going over the table. Okay, I'm going to use the 13.4 as my example. So I'm going to skip 13, the problem, the exercise 4. Let me see, 17 deserves some comments, and then we can go straight to those problems. Okay. I should have an easier math way. There you go. All right. 14. Okay, it's bond. Excuse me, is journal entry. Okay, is that what I asked you? Okay. All right. Well, like I said, I'm not gonna spend time on this one. It's a journal again. Take a look on the answers. If there's any question here, like I said, journal is not gonna be a big thing on this topic, in my opinion. More important is to understand classifications and how to do the effective interest rate method. This is more important. This, I think we have 2 different concepts of doing the journal. One is following the United States rules. The other one is following the international standards. Okay. So again, take a look on the answer. If you have any questions, of course, I will spend time explaining. Other than that, I'm going to jump to those problems. Okay. But if you do have any questions, please let me know. I don't understand why they give so, it's impossible for a professor to give you so many exercises and problems in a class. So why they bother doing so many, I don't know. I guess to sell the book. Keep on going here, look at that. Very good. Very good. First problem here, okay. All right. So let me put this problem here, okay? This is the answer, okay? I'm not gonna talk about numbers yet. I'm just gonna talk about the table itself, okay? Then I have an Excel that I prepared before the class started. I prepared a very nice Excel template, okay? Which I would like you to copy yourselves because, like I said last class, if you copy the formulas, you learn better if I just post the template for you, okay? Well, let me explain then what is this table, okay? So this table is used to compute the amortization, and when an amortization happens, when the face value of the bond is different than the price paid, okay? That's what an amortization happens. That's when an amortization happens, okay? If you paid exactly the face value, then there's no amortization, and then you don't need to worry about this. But in many cases, we buy bonds when we're investing for less than the face value, okay? Sometimes you buy for more. Then it triggers an amortization that you have to do it. All right. So the table has the date of the purchase, the date of the maturity, and all the dates of interest payments in between, okay? All right. Of course, for an exam, you don't need to write precisely the date. You can put date 1, 2, 3, 4, etc. Right? Matter of fact, I call here day 0. You're going to see my template, and I call this payment 1, payment 2, payment 3, all the way to maturity. Okay. All right. Notice that there's nothing on this first row here. The one above here. Okay. There's nothing between the date and the last number in the column, right? Because there's no cash, there's no payments, there's nothing happen on the moment that you purchase the investment. So when you purchase the investment, all you have is the investment in the amount you paid. In this case, it was 308, okay? 373.53. That's the amount you paid for. All right. Then you're going to have 2 columns here. One column is how much the bond will pay you, okay? How much the bond will pay, okay? And here is a column, okay, showing you how much would be if the interest rate, the real interest rate in the market today was applied, not the bond one. How much would you get it? And there will be a difference on those two, right? And then that difference will be added or minus, okay, into the security, right? That's the basic idea. All right, so let me now share the Excel document with you, which I created. I think will be, in my opinion, very helpful, especially for those that are still not getting 100% how to do that. All right, that's what I created here. So let's try to understand the how this function, how this works. All right. So there are two methods, remember, two methods to compute the amortization. And the most complicated one, or the trickiest one, I would say, right, that requires more attention, I would say, not tricky, but requires more attention, is the effective method, effective interest rate method. The straight line method, it's easy, right? If you haven't seen that yet on that example I gave, I'm going to give another one, okay? So take a look what happened here. You do the times zero, that's the price when you purchase the bond, and the only thing you're going to put is the amount there, okay? Put the amount there, how much you paid for. Then, on the first payment, okay, this usually happens 6 months after the purchase, or a year after the purchase, depending how often you get the payments. The bond payment, the one you're gonna get, is the face value of the bond times the bond coupon rate, the one that comes with the bond. And you divide it by 2 if it's every 6 months. Then, carrying value, which is the price paid in this case, so carrying value, look at that. So it's the carrying value, times the interest rate in the economy. They call the effective interest rate. It's going to be stated on each problem. Okay? Then one minus the other creates a difference. And that difference will be plus or minus on the previous amount. What I call previous is the carrying value above here, price paid here in this case, right? So if this number was 100 or 1,000, excuse me, let's say, here will be 1,000 plus or minus that difference, okay? If the difference here was 10, okay, and it was a plus, then it will be 1,010, the difference here. Now, I don't know how many of you probably, there you go. How many of you notice or ask yourself, okay, when should I add that difference? When should I minus that difference, right? I have an easy way for you to do it. If you put the price paid right away when you complete this table, put the price paid, and then immediately put the face value, okay? You will know if you're gonna have to add or minus that difference, okay? Take a look. Let's say the carrying value is 483, and the face value, which is right here, the maturity, right? Okay, 500. So the bond that I paid 483 has to arrive at 500 at the end of the time of maturity. So obviously we're gonna have to add the difference every year, right? 483 plus this, plus, until you get to 500. But if it was the opposite, right? Let's say here was 550, and you have to arrive to 500 because that's the face value, you just end up paying more. Then you're gonna minus that difference because 550 minus this, minus that gets you to 500, right? So that's the trick. You don't need to memorize if it's a plus, a minus, just take a look. Should I add or should I minus for that carrying value to arrive into the face value, okay? So that's the basic idea behind those tables. Now let's do those problems. I'm gonna do, I don't know, 2 or 3, okay? And I think that would be enough. I don't think there's no way for us to change this for you, right? To make it more difficult, okay? Well, one way to make it difficult would be like make it 30-year semi-annual payment. So we're gonna have to do 60 lines, but that's, it's out of purpose here, okay? We could make the interest rate every 5 years change, and then you have to do several tables. And well, anyway, we don't need to go to that extent as long as you understand the basic idea behind this. Okay, all right. I advise you to start any problem that requires a table like that the following way: put in the face value, put in the interest rate given by the problem, right? This is called the effective interest rate, and put the bond coupon rate. And if it's given, you put the price of the bond here, called bond price. There you go. If it's not given, and you're going to see certain problems will not, exam will not, you're going to have to compute that using the present value formula. Okay? You're going to have to use the present value formula on Excel or financial calculator. It's up to you. Okay? Whatever you prefer, to compute the bond price. And that's the number you're going to put it there. Okay, the first number you put in that table is exactly how much that it was paid for the bond. So if you have to do a calculation, finish, put a number there. The face value is this guy here. Right? Face value. So when you read the problem, immediately replace that with the value of face value. Then you're going to have the bond price and the face value, one on top of the other. You already know if you're going to have to minus or plus the differences. Then you compute the differences. Okay? It's my recommendation to you when approaching a problem like that. Right? So far, I mean, what you see there, it's enough for this explanation. Because when you read the problem, we're going to see that the bond face value is $700,000. Okay? $700,000. But you paid less than 700, okay? You paid $673,618.61. Now, I'm not sure if this amount was given. If someone can tell me that, I don't know if the problem gave it to you or if this was required to compute. If it was required to compute, I'm going to show how easy it is. If not, we're going to wait for the problem that will ask you to compute the present value. So I just want to remind you that in the exam, you might not have the present value, the price of the bond as a number. You're going to have the variables that you have to input on that formula. That formula is called equal PV open parentheses. That's all you need. Because take a look. All right? You're going to just complete here what's asking. It's asking you, what is the interest rate in the economy? Put it here. Put a comma. If you put a comma, it highlights the next variable. How many years or how many periods, if it's semi-annual, right? Once you're done, you put another comma. Look at that. It highlights the next. What is the payment that this bond gives to you every 6 months or every year? Okay? And then what is the face value? FV face value. That's it. Forget the rest. And you just, oh, this doesn't work. Right. And then you just close the parentheses. And that's it. Okay? Press enter. If you get a red answer, because usually you will get a red answer, if you want to avoid that in the future, you put a minus in front of that P. But if you don't, you just, the answer is going to show up in red. That's it. So let's do it. All right. Thank you. All right. Now let's complete the two other variables here. Okay. The bond pays 10% interest. Percentage symbol. There you go. All right. I'm going to put 0.10 because it's easy for the calculation. So the bond rate or bond coupon rate is what's stated in the bond. So be careful. Every problem, you're going to get two interest rates, always. One is the interest rate. The other one is the bond coupon rate. So make sure you don't confuse, because one confusion, mixing up, it's enough to have this whole thing wrong. Okay, it's like a domino effect. Okay, if you mix up the rates, because you're going to have two different rates. Because if the rates are the same, then you have no amortization. Remember what I said before? If If the interest rate in the economy is identical to what the bond's paying, then there's no amortizations to be done. All right. I believe, if I'm not mistaken, this effective rate is 11%. Yes, it is. There you go. 0.11. All right. So now we can go back and take a look at the entire table here. So let me know if you don't see that, right? I'm gonna push a little bit. There you go. Look at that. Then let's transport the values to the table. Before doing any calculation, just like plug it in, right? So let's take the bond price, right? And then you're gonna put that one, 673, 618, and 61. I formatted for one decimal place because, again, we saw last class that if you put too many decimals, A is not good to see it. It's not presentable. It's hard for the eyes. And B, we're gonna have maybe some differences. So if you minimize the number of decimals, we're gonna avoid that. All right. Now the face value, look at that. Boom. So now I notice that my bond has to go from 673 to 700. So I have to add the differences. So every difference that I have here, and it doesn't matter if here shows up plus or minus. You have to remember that this number has to increase by that difference every payment, okay? So you're gonna have to make that number 673 to increase a little bit, payment after payment, until you get to 700, okay? All right, almost done then. All right, look at this. The first payment that you're gonna receive, if the bond was paying, actually that's exactly what you're gonna receive. The bond is face value times the rate. So what you do is this, look, the bond face value is 700,000. And the bond pays, okay, now be careful when you're doing this calculation. When you're talking about the bond, it's face value times the coupon rate, not the interest rate, the coupon rate. Okay. Now remember, you have to read the problem, and I read it before. If this is semi-annual, okay, semi-annual, then you're gonna have to divide it by 2, that payment. Okay, you're gonna have to make it a division symbol or multiply by half of it. Is up to you. Okay, you can also do this times 0.05. That's more or less how the book does. Okay, so that's each 6 months you get $35,000 payment, right? Each 6 months, right? 35,000. However, okay, how much will be the effective interest rate in this case? So we go to the next column and you apply what's written there. Carrying value times the actual, the effective interest rate. So you take the carrying value from there, okay, which is also the bond price at day one, the first payment, okay, and you multiply that by half. Be careful, huh? Half of the interest rate because it's semi-annual payments. If I multiply by the entire, I get my annual payment of 74,000. But remember, you have to read the problem. If it's semi-annual, then you're gonna have to divide it by 2, okay? So I get 37 and 49, 35 in bond payment. Let's say you do the difference this way here, right? Then you got a negative difference. That's fine, okay? Not a big deal. You want to avoid negative numbers in accounting, but let's say you did this, right? Now, be careful because you already know that this number has to increase by that difference, okay? Then if this number has to increase by that difference, make sure you change that sign and put a plus, okay? Because you have to, look at that, is previous plus or minus? You have to decide if it's a plus or a minus. You decide it, right? But more than that, I think you should decide if this number has to increase or decrease. That's all you have to decide. You know this number has to increase because this number has to increase, right? That difference here of 2,049 should be a positive difference. So then it's up to you if you want to remove the negative sign, change your formula, okay? But I will change my formula here. I always do larger number minus smaller number. It doesn't matter where it is. Okay? If the larger number is in this column, it goes first. If the larger number is on this column, he goes first on this calculation. All right, now look at this. You take it, the carrying value of the previous carrying value, and you're gonna add that difference. That's it. Now that's your new carrying value. Okay, that's new one. Okay. All right. Bond payment, it's what you call fixed payment. Okay. So it has to be also 35,000. Okay. Every payment, okay, until the end is going to be 35,000. Bond payments are fixed payments. Okay, like most mortgage payments. Now, the effective payment will change payment after payment. And it's nothing more than the previous carrying value, which in this case now is 675, okay, times the interest rate divided by 2 because it's semi-annual, okay? All right, now I got 37,161, okay, giving me a difference of 2,161, which again, I'm going to have to add on the carrying value. All right. There you go. Now I have my new carrying value, okay, of 677,829, and now you repeat the process, okay? The effective payment, okay? And let me see here. Yeah, will be this one now. So look at that. Now the effective payment will be a little bit more because the carrying value is a little bit more. Okay, so that difference will increase a little now, and the carrying value will increase a little. And you're going to keep on doing this, right, until the last payment, which will be getting your 700 here. So if I keep on going this, right, with the table, okay, that's how we're going to get. I'm going to use the problem, one of the problems, problem 1, which is complete problem, okay, to do the table. But right now I'm using the exercise 4 to give you just an idea how this table works, okay? So I'm going to show one problem to you because I'm already 10:50. And I want to at least use 15 minutes of the class to talk about the next chapter, which I'm telling you, it's not critical if I don't, because the chapter 4, I will, by the way, but it's not critical if I don't because it's a continuation of this chapter in a way, right? It's just that you're wearing the other shoes. You're not the one buying the investment, you are the one issuing the investment, right? You're issuing the bond, then you get the money, you make the payments. In this case here, we receiving the payments. Those payments are being received by the company because that's an investment. But if we're doing this for the company that issued the bond, then we have to make a table similar to this one, which I'll show you, that the payments actually made by you to the person rather than received from the person. Okay? All right. Let me use, since I'm here, just to tell you that how easy is the straight line method. The table is much simpler. I'm going to use another example here. Actually, no, I'm going to use the same example. The straight line method, you only need a column for the time, the payments, one column for the amortization, which is very easy to do, and then the updating of the carrying price according to that amortization. Okay. I want to call your attention that this what I call here difference is nothing more than amortization. Okay, I could call that also amortization. Is the amount being amortized every payment. So let's keep the same names, okay, to avoid confusion. So look at that. Here I only have a column for the amortization. So basically for the straight line method, you only need those two last columns here. That's all you need. That's it, okay? Because the amortization is done in a straight line method means it's exactly the same number. So those numbers here that change in the effective rate will not change on the straight line method. So look at this formula. Price paid minus face value divided by maturity, okay? Price paid, face value divided by maturity. So look at that. Let's see what we have here, okay? And maturity. There you go. So the price paid, okay, 673, 618, right? And the face value is 700. So if I do smaller minus big, okay, I'm going to get a negative number. We're going to avoid that, so I take a bigger number. Okay. Then we're going to take the bigger number, which is 700. We're going to minus the price paid, which is 683. And then we're going to divide this by the number of payments that we have, which I just figured out now that I don't have it that handy. So give me a second. I'm going to find it. I don't think it's telling me. Yeah, it's not telling me for how long is this bond, for how many payments, okay? So let me go back there. At least I don't see it on my record. But I would divide it here by the number of payments. So 10 payments, 20 payments, right? So let's see how much is that difference. It's 26. I think it's 10 years, okay? I'm gonna guess that's actually 10 years, okay? So the difference here will be 2,638 and 14. 2,638.14. Which, if you take a look, is very similar to this one, right? 2021. Eventually, you're going to go, and this one is because it's the same, right? So it's going to be 2,638 every payment. This one is 2,000, then goes 2,100, 2,300, 24, 26, 28, okay? It's gonna keep increasing. And this one is also always 2,638. So that's the basic idea of those two tables, okay? You're gonna have to do both for the exam. So again, I hope you got a very good understanding of how this works. All right, I'm gonna use one problem, like I said, and then I'm gonna go to the chapter 14, and then we finished. So let's see if it's enough to show you just the if it's enough to show you just the answers, okay? And if it's not, then you will then you tell me, and then I will do it on the table, all right? And it's the first problem assigned. There you go. 0 to be 2 further. Problem 3. You see that they are long because a lot of them requires the journal, okay? But our concern here is really the table. Take a look. There you go. All right. So, actually, no, I'll go back on this problem here because this one I remember. There's a situation here on March 31st, okay? When there is a new purchase being made here. A new payment. So again, this will complicate a little bit our table, and that's not my purpose. Let me see if the next one shows that, then I'll go back on this one. Okay, this one is better. That's actually a straight line, but we can start. So look at this. You don't need these complex tables as you see here in the answer. You just need the table that I showed you with the difference, okay? The difference and the carrying value. Then you can take the carrying value, add the difference, gets this new carrying value, add the difference, new carrying value, etc., etc. So you don't need all this complicated table, okay? The difference is this one here, shown down here. Face value minus how much you paid gives you a difference, divided by the number of payments is the amortization per year payment. So if you want to do the math, each one, this carrying value, the next carrying value is growing by $2,048.89. Okay, so take this number, add that number, gives this new number, so on and so forth until you arrive on the face value. So you don't need this extra step that they're showing in the book. You can go as I showed you in class. Okay. All right, let me see if there's one for effective. There you go. Look at that. That's a nice problem here to discuss. Okay. All right. So here is as I showed it to you. You're going to start with the price you paid. Okay. And then you're going to put here the fixed payments of the bond. Okay. How do you do that? You take the face value, look at that, face value, times the interest rate of the bond, and divide by 2 if it's per semester. 27.5, okay? If you already have the number of year payments, because you will, it says 10 years to maturity, pays twice a year, it's 20 periods, okay? In this case here, we have 1, 2, 3, 4, 5, 6 payments, okay? So this bond was for 3 years, paid twice a year, 6 payments, right? So you can write it. You don't even need to write the date on your exam. Just put day 1, date, pay 1, pay 2, pay date, T1, T2, T3, whatever you want, okay? The amounts that you're gonna receive every time, that's the same. And here is that carrying value times the interest rate given on the problem, in this case was 12%, and divided by 2 because it's twice a year. Every payment, you're gonna get a different number, which you're gonna trigger a different difference, right? A different amortization, okay? That amortization, if you're not sure if you're gonna add or minus, you just take a look on those numbers. I paid less, I need to arrive in a higher number, therefore I will keep adding those differences until I get there. Done. Once this table is done, the next step would be doing a journal entry of the interest payments, those ones here. Okay, excuse me. The interest payments will be the 27.5. That's how much you got it. So debit your cash, okay? Credit the debit the amortization, okay, and then credit the investment or the interest income, okay, the revenue that you made, okay. As I'm showing here, if it was the straight line method, debit how much you got it, 27.5, you got this in cash. You also had to amortize your bond to more, to grow, then you debit that difference. And as Billy had said, if I had paid more, then I would credit, and then interest income or interest revenue will be the credit. And you do this every 6 months until the end, okay? So that's if you're using the straight line method. Now, if you're using the effective interest rate method, then every 6 months, that amortization here in the straight line is 2,048 every 6 months. For the effective rate will be 1,762 for the first payment, then 1,868 to the second one, okay? So on and so forth, okay? 2,224, which one was that? There you go. Here you had to do the journal entry for July 1st. July 1st, the amortization. That's what nice to have the table. If the problem asks, what is the amortization for the period 3? You just take a look at the table and locate that number. Here was amortization for the July 1st payment, 2,224, and that's the number you're gonna put it here. But on the straight line method, the amortization for July 4th is the same, July 1st, excuse me, is the same amortization for January 1st, right? Which is 2,048.89. And there you go, friends. That's how it is. And that's what I expect you to do in the exam. Two nice tables like that, okay? Starting with the price paid, arriving on the face value, right? Knowing the interest that you have to add there. And that's it, okay? That's all you need to worry about this, okay? And I think that template I gave it to you that I showed you previously can be very helpful, okay? All right. Again, if you have any questions, let me know. But other than that, I'm going to give you 10 minutes. Perfect. 10 minutes. Jump start on chapter 14. I don't think you're going to have a hard time. You did not demonstrate having a hard time on this chapter. I don't think you're going to have on the other one. Okay. Unless if you're not being honest with yourself, not with me, right? With yourself right now and not sharing any questions or anything that doesn't make sense to you right now. It's up to you. It's up to you. You make my job easy, okay, when you don't ask any questions, because I get paid the same. So it's in my interest not to answer any question. Think about that. All right. But I don't like it. That's not what I'm here for. Okay. Let's see if I want to use the slide, journal template, bond amortization, discount premium. Let me see if this is interesting. So just to kind of like use the time effectively here while those things are opening. You are now issuing a bond. You're not purchasing one, okay? So you're not purchasing one. Now you are the one looking for the money, the first hand. So this is the typical example you learn in financial accounting. You need to finance a project, okay? An expansion or a new product line, okay? I noticed that there is a delay when I speak. I hope I hope the audio is good. It's just the image seems a little slow motion. It's probably the connection that I have here. Okay. The link I post is a video to YouTube. I'm not going to go over the video. So that one you can watch if you want, okay? Because we already explained to you what's a amortization, okay, of a bond. So the only difference is So the only concern here, okay, the effective interest rate is, the table is the same. The amortization methods, the same, okay? However, the journal entries are gonna be the opposite. So I'm just gonna focus here, just giving you a few examples of how the journal entries change between one method and the other, okay? And that's it, okay? I think you're in a very good shape to do all the assignments, but again, do the best you can. And on Tuesday next week, we go over that exactly as I did today. And I think that was effective the way I did it today. It seems to me that you are understanding these topics. All right. All right. So I'm going to share with you the Excel one more time, and that's going to be the last time because I only have a few minutes. Right. Okay. So I don't think I want to explain here, spend too much time explaining why bonds sell for different prices, right? But I want to emphasize the difference between face value and price of a bond, okay? The face value is stated in the bond, is the total amount that you're going to get in the end of that investment. How much you pay for that investment is another story, okay? So if the face value is 100,000, okay, and I'm going to put here without the 3 zeros in the end, save time. If the face value of 1,000 is it's 100, okay, then this means that the price could be more than 100, could be exactly 100, right? Could be 100. There we go. Or could be less than 100. Okay, it depends. Okay, the reason is the interest rate. If the bond pays more than you could get today, then that bond goes up in price. Okay, so I bought the bond 5 years ago when the interest rate was 5%, the bond pays 5%. Today, the interest rate is less than 1%. Well, then I'm not going to sell the bond for what I paid for. I'm going to sell the bond for much more. Okay, and is the logic here is the same. If the interest rate now, today, is higher than what the bond pays, then that bond will be sold for less than 800, right? That's how it works. So that difference in price creates a discount, right? Or creates a premium, okay? Here is a premium, and here is a discount. Has to do with the amount above or below the face value, okay? So if it's above the face value is a premium, if it's below the face value is a discount. That's the terminology. All right. You already know how to compute this premium and discount because that's what we call that amount to amortize. That's the premium and the discount. You already seen that on chapter 13. You already seen the tables, effective and straight line method is the same ones on this chapter 14. So the only difference really is the shoes that you're wearing in terms of journal entry. Okay, so that's where I'm going to finish my lecture here today, show you that. If you're an investor, okay, investor or borrower, the investor buys the bond and the borrower issues a bond, okay? A bond is like an IOU, right? So if I need money, I issue an IOU. If I want to make some money on someone else's, I'll buy that IOU, right? There you go. So if you buy a bond, okay, then you have couple differences. I just want to show two of them to you. Purchase and interest. Purchase, if you're an investor, you go debit the investment bonds. Okay? And you're going to credit what you paid, right? Usually you paid cash for those things. So you credit cash. However, if you were in the other shoes, you're the one writing the IOU and giving to someone and getting the money, then you're going to debit your cash because you're getting the money, right? Debit your cash. But then you credit bonds payable. That's what you learn in financial accounting. Bonds payable, loan payable, IOU payable, right? It's what you need to pay, okay? So that's the difference between debit and credits on the purchasing of bond, depending which shoes you're wearing. And the next one is the interest, right? Which follows the amortization. The interest is here, you receive interest. And the other one, you pay interest. So of course, the journal entry will be the opposite. Receive interest, debit cash, because you're receiving money, and credit, okay, interest revenue or interest income. That's how your book calls. I'm going to call the same, interest income. Now the opposite, right? Credit cash, because you pay the interest. If I receive your interest, you pay me, you credit your cash. And you don't have interest income, you have an interest expense, then you debit interest expense. Okay? And then you adjust the amortization, right? That amount to amortize, either on the debit or on the credit as we did it before. Okay? So I think that's you have the slides, you have the book, you have this quick lecture here on chapter 14, and you have all the work you did on the previous chapter. I think you have plenty of tools to do well on the assignments on the next chapter. I do not anticipate you having any problems with that. Okay? I have nothing else to say here. So if you have any questions, please ask. If not, you're dismissed. Those that don't want any, let's do this. I'm dismissing the class, and those that have questions, stay. Let's do that. All right. Have a good week. Take care. Okay. I'm finishing here the introduction of chapter 14. That's week 3. of the class, introduction of chapter 14, and we did also all the assignments of the previous chapter. Okay, that concludes the lecture.